When you consider that yesterday the bond market reversed practically half the last rate cut anyway, just in one day, he makes a good point, doesn't he?
Yeah, I'm a bit confused about the Fed, to be honest with you. I mean, on the one hand, they deserve a lot of credit for having moved incredibly fast or early in this sort of potential slowdown, thereby helping cushion, not prevent, cushion the U.S. slowdown. But their dots are still sitting way above the forwards, and the message sort of holding back firepower, which if that's what he was saying, I as an economist, you would say that doesn't make any sense, because if you're holding back firepower just to have it, you are actually increasing the probability that you need it, right? So they confused me a bit. At UniCredit, we are in the camp who think that the Fed is going to cut a lot more than what they say now.
Really, Erik, and will it come sort of in one go? Will we see a significant slowing of the economy or a movement in the treasury market? What will signal that the Fed is going to have to move and quickly?
That's a tough one. For us people, for those of us who think that the U.S. will hit recession or near recession sometime late next year or 2021 or thereabout, there is not because rates are so low, inflation are low, labor markets are still good. It's not a cliff edge event that takes you down into recession. It's more the boiling frog story of slowly, labor markets sort of hit you, and therefore you're having a slow move down. So our guess is therefore that the Fed, they will probably end up cutting another 3-4 times for a total of 100 basis points or something before they trough out. But it's going to be gradual as they see and slowly get convinced that the U.S. economy is actually slowing. So our base case scenario here is several cuts, but gradually and slowly.
Okay, the market is definitely not priced for that, Erik. Just looking at pricing now, we have got 21 basis points of cuts priced in by the end of 2020. How out is that? That's what market pricing is right now.
Yeah, I take the other side of that coin. That's how trades are made. I think that's how money is made. But so I'm very happy to take the other side of that story. And on our probability models, these are models that all economists run off labor market data, typical labor market data, but a whole different bunch of things, but not the yield curve story, right? On the macro story, a normal probability model would tell you that there is about a 50-50 chance of a recession in the U.S. In third, fourth quarter of next year. So, and it goes up dramatically after that. So then you look at the curves, which are flirting with inversion, and you see it's the longest expansion in modern history. You're thinking about the fiscal expansion that powered ahead the U.S. economy in a way you hopefully don't think that is something that is a gain that would never have to be paid back. There's no free lunch in life. And then you start to say, is this economy not going to slow? Yes, the Fed is doing a good job, but if a central bank knew how to prevent a recession, we would never have recessions, right? So of course it's not going to be enough. It would cushion it. I'm not going to make a big argument whether they bottom at 0 or 0.5%, but they will slow. They will slow, and the Fed will react further to it. So very happy guy to take the other side of that bet.